Our next lecture is on coinsurance and reinsurance. Both these methods are risk transfer mechanisms. Let us look at coinsurance. This type of arrangement is when an insurer takes part of the risk and then the remainder is taken by other insurers who follow the leading insurer. Let us take an example. A broker approaches an insurer with a risk of a very high sum insured. The first insurer approached might want to take the risk, but only in part. So, the broker will place a percentage of the risk with the leading insurer, who will issue the policy terms and conditions on that risk. Then the broker moves on to other insurers to try and secure the full risk. The other insurers will merely follow. In view of the fact that the leading insurer has done most of the work, a commission is due to the leader. Reinsurance is also a risk transfer mechanism. It has the advantage of bringing peace of mind to the insurer. Also, it avoids fluctuations in one's portfolio, especially in the case of a stop-loss arrangement, which we shall be looking at very shortly. Thanks to reinsurance, an insurance company can increase its capacity to underwrite, therefore accepting business even if this is beyond its underwriting capacity. Also, reinsurance assists in dealing with catastrophic losses, and on a wider scale, it brings macro benefits to the economy of that country. There are two forms of reinsurance, the facultative reinsurance and the treaty reinsurance. A facultative arrangement is a one-off arrangement whereby an insurance company will approach a reinsurer only when the need arises, as opposed to a treaty where a long-term agreement is effected between the insurer and the reinsurer. You will understand that treaty reinsurance is cheaper and more secure in that the insurer knows that there is support in place. Unlike facultative insurance, where the insurer tries to place part of the risk with the reinsurance market on a one-off basis, which is not always available. The types of reinsurance can also be divided into two. There is proportional reinsurance, in which quota share and surplus arrangements are made, and non-proportional reinsurance, where we find mechanisms of excess of loss and stop loss. Let us look at quota share. Quota share insurance is based on proportionality. When the full risk is presented to the insurer, that insurer is responsible to take on 100% of such a risk. Therefore, the insurer takes the full premium and of course is responsible for the payment of the full claim. Then the insurer keeps part of the risk and reinsures the rest. In this example, we are assuming that the insurer has kept 25% of the risk and reinsured 75% of it. Of course, the premiums and the claims are likewise proportionately shared. Let us take an example of surplus reinsurance. We shall be talking about a 5-line treaty. In such an arrangement, the insurer will retain one line. This retention is the amount of risk that the insurer is ready to accept. If it is a 5-line treaty, as an example, if the insurer is ready to accept €100,000, then a 5-line treaty would mean that the reinsurer can take 5 times the retention of the insurer. In this case, therefore, this means that a reinsurer is able to support up to €500,000. In total, this 5-line treaty means that risks up to 600,000 can be accepted. Let us demonstrate excess of loss. In excess of loss insurance, we are reinsuring losses. Let us take an example. If the insurer is ready to take up losses up to 100,000, then an excess of loss agreement would mean that the reinsurer may take up losses up to a certain amount. Again, this is an example. If the insurer is ready to take up losses up to 100,000, then a reinsurer in this example will support by taking a further €800,000. Beyond this amount, of course, the insurer becomes responsible for the losses again. Let us demonstrate stop loss. Stop loss seeks to control the loss ratio of an insurance business. The loss ratio is the amount of claims paid over premiums received. This is an indicator of how the insurance company, is performing. Of course, a loss ratio of above 100% is a loss indicator, and insurers would be very interested to control such losses. This they can do by effecting a stop-loss reinsurance cover. Let us take an example. If an insurer wishes to stop the loss at 90%, then it takes out a reinsurance contract with a reinsurer to take losses beyond this 90% threshold. Let us say the reinsurer has contracted to take loss ratio losses from 90% up to 115%. Beyond this, of course, the insurer becomes responsible again.